Before we begin this podcast, we'd like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth's financial products. For NetWealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the podcast guest. More information about the fees NetWealth receives is provided in our financial services guide, which is available on our website or by contacting us.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
My name is Paul O'Connor and I'm the Head of Investment Management and Research. My role at NetWealth involves managing the investments we offer to clients, and we've recently worked with Franklin Templeton to offer the Franklin Global Growth Model through our platform. With me this morning is Don Huber, who is the Portfolio Manager of the Franklin Global Growth Model. Good morning, Don.
Good morning, Paul.
Before we start, can you give the listeners some background on yourself and how you became involved in the investment management industry and ultimately today working as a portfolio manager?
I started out as a banker, a commercial banker, lending to media companies. And this was back in the days when they were laying cable television companies were laying cable in the ground to establish television networks. Or cable television systems. So I guess that dates me a little bit. But I moved from there into private banking. So I'm familiar with the work of advisors and working with private clients. And then from there moved into asset management when I saw an opportunity to work on strategic planning at what was then a bank that became part of J.P. Morgan Chase. Loved asset management, shifted into portfolio management, and then 17 years ago had an opportunity to go to really a pure play investment management company in Franklin Templeton, and so I made the move.
Thanks for that there, Don. So you're the portfolio manager of the concentrated global equity model, and we made this available last year to investors. For those less familiar with the model, can you explain what the objectives and the parameters of the investment strategy are?
The objectives are to add value over the benchmark and outperform in a select group of international or global equities. We build a portfolio of roughly 20 companies in the portfolio. Look to find attractive growth companies that fit our model and are appropriate to own for the long term and are attractive with a number of great growth drivers behind them, and put them together in a portfolio that, despite being concentrated, is a diversified portfolio with exposure to a number of different underlying drivers.
That must be a challenge. How do you actually balance having a concentrated portfolio and keeping it diversified?
Yeah, there are a couple of ways to think about diversification and manage diversification. And one way that is often done is to think about sector concentration or regional concentration and maybe limit the allocation in a portfolio relative to a benchmark. For us, we think that that's not appropriate, and really for a couple of reasons. I mean, one is that we're benchmark indifferent as we're building a portfolio, so to tie our risk management to a benchmark is not really suitable. And the other is that knowing a sector a company's in doesn't really tell you much about the underlying business. Knowing the region where a company is based doesn't tell you much about where they're earning revenues or where their business is. So we take a deeper fundamental approach and we think about the underlying drivers for the companies, the drivers for its revenues, the drivers for its expenses, and look to limit the overlap between those drivers. And the end goal is that if we have a group of about 20 companies in a portfolio that all have different drivers, then they should, if share prices follow fundamentals, which we believe they do ultimately, then we should have a diversified group of companies in the portfolio.
So I guess for the listener, it's more about getting a diversified portfolio of companies by income stream there. That would provide some type of security in the portfolio for investors. How would you describe the team's approach to managing money?
Team's approach is definitely, the culture is definitely one that's rooted in managing concentrated portfolios. So we have two styles or two approaches that we take. One is 35 to 40 companies in a portfolio, and the other is 20. So, our bread and butter, our culture is one that's definitely focused on managing concentrated portfolios. Where we particularly look to add value is through the quality of our research, the depth of our research. Our analysts only cover companies that we own, so that we don't need analysts covering a lot of companies individually, and they can really get to know those companies on a deep basis. And we think that's important when you're managing a concentrated, high conviction portfolio, that you do the research so that you've got the high conviction in the companies that you own.
Yeah, absolutely. Franklin Templeton Investments is a long-standing global investment firm, and the origins in the US date back many years, I think to the 1940s there, and I think Sir John Templeton, who's a very well-known investor, is one of the founders of the business there. How long is the track record of your team, and for how many years has your investment capability been distributed and made available in the Australian market?
Yep, our team was put together originally 15 years ago. So we have a 15-year track record and a 15-year track record in Australia, but on the institutional side. We started our retail mutual fund here, in a broader portfolio, again, 35 to 40 companies in the portfolio. We started that a little over 10 years ago. And then a little over 3 years ago, we initiated the SMA product for Australia.
Thanks for that, Don. Global equities in Australia, it's a fairly contested space with a number of boutique Australian managers offering, very successful global equity products. Most of, I guess, the large global investment management firms are also in the Australian marketplace. So how would you think you differentiate yourself from the growth investment philosophy peers in the market? And I guess we do have a proliferation of growth style managers, more growth global equity managers than value certainly are available in the Australian market. But how do you differentiate yourself from your peers?
It is a very strong and a competitive market. And as you noted, a fair number of global managers, which is different from other geographies like the U.S., for example, where international equity managers tend to be more concentrated on the value side than the growth side. I think we differentiate ourselves in a few ways in this market with our strategy. One is that we're concentrated and more concentrated than many of our peers, and certainly in an SMA portfolio of 20 stocks. But managing concentrated portfolios is our culture. It's in our DNA. It's what we do. It's the only kind of portfolio that we manage. A second way that we differentiate ourselves from many is that we're benchmark indifferent. So we're willing to own great ideas no matter where we find them, and really not tied to limiting ourselves to a benchmark type exposure. I think another way we differentiate ourselves, is the type of companies that we own. Because we like pure play businesses, because we like buying companies a little earlier in their growth cycle, the strategy naturally takes us down the market cap spectrum. And so we include a fair number of mid-cap companies in the portfolio. And so if you look at our strategies on a style chart, what you tend to see is that we have a lower weighted average market cap than other managers, and that we tend to be growthier than other managers as well. And this not only creates a different style, but means that we also blend well with other strategies and other managers, because you'll see low overlap among our holdings. And the last way I think we differentiate ourselves, and I touched on this earlier, is the way that we manage risk, that we're focusing on the underlying fundamentals, the revenue and the expense drivers, to limit the overlap, limit the domino effect that you could see in a portfolio in the event of a pullback in any one of the underlying drivers. And from what we're told by investors, that tends to be a differentiated approach.
That's interesting there, Don. You mentioned before there that you like to buy pure play businesses. Can you explain to the listener what you mean by pure play business?
Sure. I mean, what we like about a pure play business is a business that's focused on one specific end market. And in some cases maybe two or three, but a very focused business. An example of that in the portfolio is a company called Shopify. And they're a software business. All they do is provide software and services for e-commerce merchants looking to manage their business online. They're not in a number of other businesses. They're not buried within a large conglomerate where understanding the growth drivers, understanding the fundamentals of the business are much more challenging. And because it's not buried in in a conglomerate, let's say, where you've got some slower growing businesses on the side and some less attractive businesses, we're invested in a pure play where typically we'll see better growth because we picked the best part of a conglomerate and chosen a company that just focuses on that business.
No, thank you, Don. And I guess as you're explaining what you understand to be a pure play business, I'm thinking very much it sounds like the net wealth business as a pure play platform provider, and that is all we do.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
When you have a look at the portfolio, I guess you've got a number of names there, companies that you're holding that you wouldn't consider are a household name. Can you give us a bit of a feel for some of these names and how the investment opportunity was identified?
Sure. I'll start with the latter part of the question and how we find ideas. And I think, typically what an analyst may be doing, and we generally have sector analysts who are specialists in the consumer side or in the cyclical side or in financials. So they're thinking about where in the portfolio we don't have exposure, and where there's attractive secular growth. So what are we missing out as growth managers that we think could be attractive? And then you drill down and you think about the industry and how the industry is structured, where the value added is, where the IP is, where the better growth is, the better margins, the better cash flow characteristics. And then you drill down and see if there are attractive companies that fit that model. I'll give you an example of a company that we own that's differentiated and certainly not a household word, a company called Umicore, which is a Belgian precious metals company. And it's one, as I travel and talk to investors, pretty much nobody has ever heard of before. Very niche business, but among the leaders in their field in those businesses. So one business is recycling, and they're really the only company that takes mining output, industrial output on a massive scale and recycles it back down into precious materials. They've actually built the world's first large-scale facility to recycle hybrid and electric car batteries, which we're not thinking about right now, but the OEMs are, because ultimately they take them back. They've got to take them back and dispose of them somewhere, and so they've got contracts with a number of them. They make materials that go into rechargeable batteries. One of the few companies in the world that has a leading position in that business. And they're going to benefit clearly from hybrid electric cars and the increased penetration. And then on the other side, for those of us still driving internal combustion engines, and most of us will be for the next many years, they make platinum substrate materials that go into catalytic converters, and benefiting there in that business from rising emission standards globally, and the value add that they bring. But again, a name that's not well known, but among the leaders in its fields.
No, thanks for that, Don. So if you come up with 20 of these good ideas, how do you then actually work out what type of weight in the portfolio to hold each stock in? So would it be an equal 5% for all the 20 names, or can you provide myself and the listeners an understanding on how you build that portfolio?
Sure. In general, the weights will vary somewhere between 3 and 6 or 7% in the portfolio. And as we think about the weights, it's a combination of relative valuation, what the value of the company looks like relative to other companies in the portfolio. Near-term fundamentals, visibility into the near-term business of the model, kind of predictability of the business model at times. Volatility will, capture a little bit to a certain extent. It's not a big trading portfolio by any stretch, but will capture volatility when share prices pull back and we think they've been unfairly penalized, and take advantage of opportunities to add to the position. Generally, I'd say we look to add a little bit of value through position sizing, but really the driver for the portfolio and the driver for performance is going to be whether a company's in the portfolio or not, which is typical in a very concentrated portfolio.
And I guess intuitively makes sense for an outsider looking at an active manager. It's about the quality of your research and your research team uncovering these opportunities. Over the last few months, and I guess certainly the last quarter of 2018, we saw volatility certainly, come back into the markets. And I guess this started to raise questions about 2019 and, what is ahead for us. We're hearing increased debate about late cycle. I guess the cycle has been going now for over a decade, the growth portion of the cycle. I think it's the longest cycle ever recorded in history. What's your view about where we're at in the cycle, and are there still investment opportunities that you're uncovering? And I guess also with the amount of volatility in markets, back to your earlier comment, that could be another source of opportunity for your strategy.
Yeah, I think conceivably, we won't know until the cycle's over whether we're, how far into the cycle we are. But I think it's very conceivable that we are at the later stages of the cycle. As you point out, it's been a very long cycle, but at the same time, it's been a very slow recovery, which, thinking back to recovering from a cycle that was where the downdraft was driven by financial crisis, it's not completely unexpected that it would be a long recovery and a long way out of it. So, many people talk about we're kind of overdue for a correction, we're overdue for a recession, and that's yes, if you look just at the numbers, but if you consider how slow the recovery's been, I don't think so. We are still certainly finding great ideas, and our portfolio is really not economically dependent. I think as you look at the companies that we own, some of the companies may have some cyclicality attached to their underlying business, but ultimately they're benefiting from very strong secular growth drivers that at any point in the cycle will be additive. We own a company called Aptiv, for example, which is an auto equipment supplier. And so, yes, there's some cyclicality attached to auto production, but really overwhelming that is the fact that they're supplying critical technology for auto companies who are increasingly building electronification into their cars through, shifting to hybrid and electric cars. And so a company that's providing technology for that benefits greatly. And a number of the safety steps that lead up to automation in autos and kind of every step up to autonomous driving, but really with a feature set that's increasingly being demanded and increasingly being offered in cars, things like lane warning systems or adaptive cruise control. And so the secular drivers are really overwhelming or help compensate for, at a minimum, the cyclicality. And that's the kind of great growth drivers that you're going to see at any point in the cycle.
No, thanks for that, Don. And I guess an interesting point you make there for listeners in the fact that there is still, many companies out there, particularly in the consumer staple space, who their earnings are not tied to the economic cycle. So you can get a more stable portfolio as well. And, you can have opportunities, I guess, in that space when you do get volatility, you get market sell-offs, and you get some companies then looking quite cheap as a result and not with a high risk to their earnings over the medium term there. Are there any structural trends that your team's identified that's influencing in industries, multiple industries? And if so, can you share with us a couple of examples of the companies you feel will benefit from these trends you've uncovered?
Sure. We tend not to be or consider ourselves to be thematic investors. So we're not identifying themes and then building a portfolio or around a particular theme. For us in a concentrated portfolio with our risk management approach that conceivably could give rise to, again, the domino effect that I talked about. But there are some underlying drivers that we find as analysts bring ideas forward on a bottom-up basis that are, consistent from company to company. One of those is certainly e-commerce and the shifting of making retail purchases from brick and mortar stores online. It feels like we're late in the game in that shift, and it's kind of old news, but we're still finding opportunities where there's tremendous growth. So Shopify is an example of that kind of company where they basically provide the backbone for companies to manage their online business. and just seeing phenomenal growth in excess of 40% year on year, and growth of merchants that are still listing with them. So still great growth there. Another kind of a different part of the world where we continue to see very strong growth from the shift to e-commerce is in Latin America, with a company called Mercado Libre that we've owned for quite a few years. Really the leading online retailer in Latin America, just purely a storefront for third-party sellers. They're not managing their own business. They don't have inventory like Amazon carries, but just a storefront for third-party sellers. And there in Latin America, e-commerce is really still in its infancy as a percentage of overall commerce. And so we see just tremendous growth with Mercado Libre, which has a first mover advantage and really dominates the e-commerce area.
Very interesting. Some market commentators are suggesting that, I guess, the extraordinary tailwinds experienced by growth style managers, over the last decade are now starting to abate. Why should investors remain confident of the ability of your strategy to deliver alpha in a benign or perhaps even worst case, a bear market?
Yeah. I think about our strategy and how we add value. It's, as I said, it's ultimately through stock selection. It's through owning a great group of growth companies whose growth is in many cases not cyclically exposed at all, or really related to tremendous technology that they're bringing forward, tremendous innovation that they're bringing forward in their companies. And, that's not dependent on where we are in a cycle. It's not dependent on where we are economically. These are businesses that are going to perform well over time. Technology, we're at a point now where technology is pulled back a bit, and where investors are concerned about underlying growth trends overall and macro growth trends. And as I think about those two concerns, the valuation of tech companies and concern about economic growth and growth that seems to be slowing globally, I think they're at a bit of a discord. Technology companies have great growth, have strong innovation, and in many cases have growth that's not dependent on the economic cycle. So they tend to be among the least economically sensitive companies in some cases. And so to be concerned about tech valuations and tech earnings at the same time that you're concerned about economic slowing, to me seems, as I say, a bit of a mismatch. I think there are always going to be great opportunities for tech companies, for others that are innovating and bringing great products to market in a leadership position.
Thank you. And finally, have you got any investing tips or rules that I guess you've developed over the course of your career that you might be able to share with the listeners today, Don?
Yeah, I guess I'd share two, and they're very broad, but they really are kind of the hallmark of what we do and what we strive for. The first is clearly do your homework. As you're investing in a company, it takes our analysts on average 3 months to bring an idea forward for investment. So they do a tremendous amount of work. So do your homework so that you've got conviction in what you're owning. And then the second is stay true to that conviction. The markets will come and go over time and move, and sector rotation will take place. But ultimately, maintain conviction in your idea, stay true to the fundamentals, stay focused on the fundamentals, and ultimately, if you've done your homework and identified the right opportunities, those will be profitable for you.
Very interesting. And well, on that note, I think we'll finish up there. But thank you very much there, Don, for providing your insights and thoughts today for myself and the listeners. For the listeners there, the Franklin Concentrated Global Growth Model is now available on both our superannuation and our non-superannuation investment platforms. So if you would like to find out some more information, simply jump onto netwealth.com.au and you will be able to find a lot more information about the strategy there. So again, thank you very much for your time today, Don. Very much appreciated, and all the best for your travels across Australia for the remainder of the week.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.